Hi, I'm Christine Benz from Morningstar.com. April 18th is your tax filing deadline for the 2015 tax year, and it's also your IRA contribution deadline for 2015. Joining me to share some tips on those contributions is retirement expert Ed Slott. Ed, thank you so much for being here.
Great to be here in Chicago.
Thank you for being here in studio.
Yep.
Let's talk about April 18th. It's the tax filing deadline this year, and it's also your deadline for making an IRA contribution. One key piece of advice you have on that front is don't wait till the very last minute.
Yeah, it probably doesn't matter that I tell people that. The people are going to do it anyway. They like the rush of being at the post office or at the bank the last minute. But it's different than filing your taxes. You have to get an IRA contribution. That's the last day to get an IRA or Roth IRA contribution for last year, for 2015 in. And there's no extension. So even if your regular return is on extension, there's no extension for making a 2015 contribution or a prior year contribution past the normal April 15th, which is now April 18th this year because of a holiday. But don't wait till then. Try and do it at least a week before. You can get the same rush.
Okay. So it's a little bit confusing for people attempting to sort among the various income limitations that apply to a traditional deductible IRA and Roth IRA, but you say it's really important that people make sure that they are eligible to make the type of contribution that they're trying to make.
Yeah, things change, and you have to know the eligibility rules. And unfortunately, the tax code made it more complicated. For the most part, IRAs and Roth IRAs fall under IRAs, but the rules for eligibility are almost opposite. For example, with IRAs, there are no income limits. With Roth IRAs, and we're talking contributions only, there are income limits. They're very high, but they're income limits. For Roth IRAs, there's no age limits, but for IRAs, traditional IRAs, you can't fund a traditional IRA for the year you turn 70 and a half or later years. So you have to make sure you're eligible. And of course, to do either, you have to have earned income. So people in retirement say, maybe I can just keep funding this, contributing. No, you have to have earned income. That's W-2, wages, self-employment income. The only exception to having earned income is for something known as spousal IRAs. If you have a spouse that's not working, that doesn't have wages or self-employment, that spouse can use the working spouse's income to qualify. But the spouse still has to qualify on their own. For example, if one spouse is working, say one spouse is working and that spouse is in their 60s. But the other spouse who's not working is 75. Now, the other spouse who's not working, who's 75, can use that spouse's wages, but she doesn't qualify anyway because she's over 70 and a half.
Okay.
So, but she could qualify for a Roth where there is no age limitation.
Right. So one thing I wanted to ask, though, is if I inadvertently fund the wrong IRA type, so I open a Roth IRA and I wasn't eligible to make a contribution there, what's the workaround? What do I have to do?
Yeah, it gets a little complicated. First, make sure you're eligible before you do it, because it gets a little messy. There's something called a recharacterization where you can undo it. Say you did exactly what you said. You did a Roth, but your income was too high and now you can't have a Roth. You could recharacterize it as a traditional IRA, as long as you would have qualified for a traditional IRA anyway. For example, let's say the reason you didn't qualify for a Roth is because you had all these earnings. You have the earnings, but what if you were 75? You can't recharacterize to a traditional IRA because of the age limitation. You wouldn't have qualified. Then it has to come out, plus any income on that. Otherwise, you have a 6% excess contribution penalty. So it's got to be removed by October 15th of the year after the contribution was made. So it gets a little messy. Make sure you qualify, you're eligible, and you contribute to the right account, whether it's IRA or Roth IRA.
Okay. So you've mentioned a couple of times these income limitations that apply to direct Roth IRA contributions. A lot of people in recent years have been talking about this workaround, sometimes called the backdoor Roth IRA. Let's talk about that. And you say it's a little bit of a misnomer because really it's kind of a two-step process.
Well, I wouldn't call it a backdoor Roth. People call it that because it's a way to get money in a Roth, even though, let's say you were over the income limit for a Roth, but you're not over the income limit for a traditional IRA because there are no income limits. So it's two separate transactions. You really want a Roth, but you have to start out by contributing to a traditional IRA. It might be non-deductible if you're active in a plan. If not, it could be deductible. But you don't really care about that because your real intention is at some point getting it into a Roth. Once it's in an IRA, so now you qualify for a traditional IRA contribution where you didn't qualify for a Roth because your income was too high.
Right.
Now you made your, say, $5,500, or if you're 50 or over, $6,500 into a traditional IRA, maybe a non-deductible traditional IRA. Now, at any time, if you want, you could convert that to a Roth IRA because there are no income restrictions. There were years ago, but there aren't anymore. So you could convert that at any time to a Roth IRA. Now you have what you really wanted all along, and that's why people call it a workaround. In the Roth IRA, you have that same money because you converted it. But it's different. It's not a Roth IRA contribution. The money went in as a conversion, which makes a difference if you're under 59 and a half. Because if you just did a straight Roth contribution, money you contribute to a Roth can always be withdrawn at any time for any reason, tax and penalty free, even before age 59 and a half. Not true with converted funds.
Okay.
So you could have a penalty if you withdraw converted funds too early. But if you're thinking of keeping it long term, past 59 and a half, and you have the 5 years, then it shouldn't matter.
Okay. So a question is, if I've opened this traditional non-deductible IRA and then I want to do the conversion to get myself a Roth IRA, how long do I have to wait?
Nobody knows.
Okay.
Nobody knows.
Why is that?
Nobody knows. You know, I would wait maybe a month or something, but I saw this on a tax service. A very smart tax guy said the same thing. What's the time limit? Nobody knows. And he said, but I think it's the same time you have to wait to remarry after a spouse has died.
All right.
So it's when you feel comfortable.
Okay. That may be a good long time. But let's talk about some caveats that come along with a backdoor IRA. There are some inadvertent tax issues that you can trigger by doing this conversion. Let's talk about that.
Well, one thing is you have something, I don't want to be too technical, but a pro rata rule where people think if I do a non-deductible IRA and convert it, that'll be a tax-free conversion. Not always. Not if you have other IRA balances, and that includes SEP and simple IRAs. So you have to do a proportionate amount. So it could be if you have a lot of other IRA money, most of that money you're converting will be taxable. But that's okay too if the whole idea is to get it to a Roth. But in most cases, unless you have no other IRAs, that conversion is going to be either all taxable or partly taxable.
Okay. Last question on this backdoor Roth IRA, even though you don't like the term.
Two separate transactions.
Okay. Last question, though. A lot of people have looked at this maneuver and have been happy that they've been able to get this money over into the Roth column. But people are concerned that Congress could close this
No,
loophole.
It's not even. They had so many chances to do it. If that ever happened, I think they have bigger fish to fry in Congress than letting people put money into a Roth. And remember, the only money that goes into a Roth is already taxed money. I think if Congress opened that door, they'd miss out on the gravy train on all that money they're getting from people putting money in Roth IRAs, because then people will think, oh, maybe I shouldn't convert. Maybe if they're going to do this, they'll go to the next step and the next step. I think you're okay. And in worst case scenario, I think if they ever did something that outrageous, which I think it would be because so many people have Roth IRAs, and who knows how the money got in, whether it was this backdoor or contributions or conversions, they would stop putting money in a Roth and the government would be out all that tax money they're actually counting on in their budgets now. And I think worst comes to worst, it would grandfather people that were in it. But I don't think that's something to worry about. But I get that question in almost every consumer seminar I do. And the question goes something like, can I trust the government to keep its word that Roths will always be tax-free? And it brings in too much money. You know, it's the only provision that our legislators have been looking for, this kind of provision for over 200 years, something that brings in money and people like it. It's never happened before. I don't think they're going to kill the golden goose.
Okay. Ed, thank you so much for being here. Lots of valuable tips for IRA contribution season. Thanks for watching. I'm Christine Benz for Morningstar.com.